Okay, hi everyone. Welcome to Master Key Associate. Today we are going to continue with our simple group account for financial reporting, FR. So, according to your syllabus, okay, the group account you are supposed to do is called a simple group account. That is a group account with a parent company that involves one subsidiary and one associate. Okay. So we are going to do the balance sheet and the P or L. So far, we have dealt with the group balance sheet, okay, your SOFP between the parent company and the subsidiary. So whatever you have learned, okay, in that class is 100% applicable now. Okay. So today we are going to go a bit higher by incorporating an associate, okay, investment in associate. That is a requirement of the syllabus. A parent company, one subsidiary, and one associate. So IAS 28, investment in associate and joint venture. Investment in associate and joint venture. Now, our focus today in this class is to prepare a consolidated statement of financial position that will involve the parent company, the subsidiary, and associate. So after this, we are going to the P or L, the P or L. So IAS 28 is titled Investment in Associate and Joint Venture. Is that clear? What is the objective of this standard? Like I've always told us that for every standard, there is a particular objective. Yeah. So IAS 28 prescribes the accounting treatment and guidance on how a parent company that has an associate or joint venture should account, okay, should account for its interest in the associated company. Plus, there is a difference between investment in associate and subsidiary. Is that clear? You know, over subsidiary, the parent company has control. Okay? The parent company has control. You have control by the virtue of the fact that you acquired more than 50% of the equity shares of the subsidiary. Hope you remember, you have control. And what is the treatment? You consolidate. Okay? By consolidation, you are going to add the subsidiary assets, liabilities with that of the parent company. Like you have seen, that is called consolidation. The parent company is consolidating because it has control. So it is the parent company and the subsidiary relationship. Exactly. So now, what do we mean now by associate class? Associate. According to IAS 28, an associate is an entity over which an investor has significant influence. Okay, significant influence, and which is neither a subsidiary nor a joint venture. Now, associate is an entity in which you, as an investor, as a parent company, has significant influence and not a control. Okay, you only have influence, not a control. Exactly. Now, how do you determine whether an entity is an associate or not? IAS 28 says that if you acquire between 20% to 50% of the equity shares, so this will give you associate. between 20% to 50%. So any acquisition within this range, okay, is what defines an associate. It means if you acquire less than 20%, let's say from 19 downward, what you have there is called an ordinary investment, okay? Ordinary or simple investment. Is that clear? But any acquisition from 20% to this range, okay, is called investment in what? In associate. Is that clear? Please take note. Okay, so because it is an associate class, you do not have control. You only have significant influence. Is that clear? That is what you have. So let's go on. Please, is the board clear? Hello, class.
Yes, sir. Very clear. Very clear, sir.
Okay. Thank you. Thank you. Now, you see, sometimes, okay, an investor might not even have up to 20%. Yes. Still, he has what? Significant influence. Is that clear? But for the sake of understanding, we have a range 20% to 50%. So that is that. Next, now, what do you understand by significant influence? Class, recall that in subsidiary, we use control. Control. Yes, there is a difference between control and this. Control is that I will tell you, stand up. Abi, you stand up. Sit down, you sit down. Go out, you go out. That's control. Yes, by the virtue of my acquisition and power, that's control. But in the case of associate, okay, the investor does not have control. Hello, does not have control. Rather, it has significant influence. Okay, please mute your mic. Hello, mute your mic. Over there. Now, significant influence. Hello, please mute your mic, please. Cecilia. Cecilia, please mute your mic. Now, significant influence, okay, is the power to participate, okay, in the financial and operating policy decision. Yeah, in the financial policy and operating policy decisions. Class. So it is the power, okay, to participate. Look at that keyword, participate. Not control or impose. Are we there? To participate in what? In the financial and operating policy decision making of an investee, but not a control or joint control. Exactly. So this is the power to participate in the financial and operating decision policy making of that investee. Okay, of that investee. That investee is the company in which you have investment. Exactly. Of that investee. So that is that. Okay. Like I said earlier, according to IAS 28, which is the standard on investment in associate and joint venture. The standard has given us a detail. Let's look at it now. Detail of what you need to know. Let's say indicators of significant influence. Please, class, I want you to know this. What are those signs? The indicators, right? That shows that I have a significant influence. Is that clear? So, number one is representation on the board of directors. Representation on the board of directors. Representation on the board. Yeah. You can be represented, okay? You also have right to nominate. Is that clear? So, representation on the board of directors. When an investor has the right to nominate, okay, for the board of directors, you have a significant influence. 2, participation. In the policy decision making process. Yes, when you are able to be involved, you are able to be involved to suggest. You are just suggesting. They just give you the free, the right to air your view, to be involved in the policy decision making. It shows there is a significant influence. The next, material transaction. Material transactions between investors, and investee. Yeah, the investor could be the parent company, who has acquired 20% in the associate. So the investee is that associate, where you have acquired 20% or more. It is possible that the parent company, might also raise finance, or might stand as a surety for the associate to get finance. So that is that. The next one now, interchange. Of management personnel. Class, after the acquisition, it is possible that the associated company, might have a challenge with a particular personnel. So the parent company or the investor, in its wisdom, might have one of its employees who is well experienced in that field. So the parent company might send its employee there, to help fill the gap out there, or to train the employees of the associated company. So that is called interchange of what? Of management personnel. That talks about the skills, okay? The skills. A particular skill might be lacking in the associated company. The next now, provision of technical information. Yeah, there could be an exchange of an important information between the investor and the investee. The investee there, class, is the associate. Is that clear? The last now, yeah. Acquisition of potential voting rights. That is, the moment you acquire 20% of the equity shares of the associate class, any of this, if you see any of this, is an indicator that what we have here is a significant influence, that the investor has significant influence. Is that clear? Please take note of that. It's been a while that I can test this aspect, okay, of the question. So that is that. Now, don't forget, class, that for you to have a significant influence, you must have acquired what? At least 20% or more of the equity shares of the associate. So when you now have an investment now in associate, how do you account for it? Okay. What is the method of accounting you are supposed to use? This is very, very key. How do you account, okay, for the investment in associate? Because this is not the case of subsidiary now, that you do a full consolidation. Is that clear? So because here there is no control. So accounting for investment in associate. Yeah. How do you account for your investment in associate as an investor? So according to IAS 28, investment in associate should be accounted for by using equity accounting what method. Please take note. Investment in associate class is to be accounted for by what? Using equity accounting method. Please and please take note of that. This is not a subsidiary. You don't have control. Therefore, you cannot consolidate. You cannot add the associate asset and liabilities. No. You should only take account of what is your own share of interest in the associate. And that can be determined through the equity accounting method. Okay, now, what is the meaning of this now? Let's see. Equity accounting method, okay, is an accounting method whereby the investment is initially recorded at cost. Hear me? At what? At cost. Yes, it's an accounting method whereby the investment in the associate, okay, is initially, okay, recorded at cost, and thereafter adjusted for the investor share in the post-acquisition changes in the net asset of the associate. What are we saying? Initially, okay, you are going to what? Recognize your investment at cost, the actual amount you invested. Then, if there is any share of gain, okay, you also add. If there is any loss on your investment, you subtract. That's all. So it is initially, okay, recorded at cost. At what? At cost. And adjusted thereafter. And adjusted thereafter for the post-acquisition changes in the investee net asset. So let me now give us now the full detail of this method. First, of cost of investment in associates. So how do you now determine the total value of your investment in associate? So we are going to apply the equity accounting method, because in the statement of the financial position class, what you are going to show is just going to be a single line item, okay, under the non-current asset. That will be investment in what? Associates. That's all. You will just show this, okay, with the what? With the figure. You are not going to add the asset or liabilities in the case of the subsidiary. So this is what will tell us the total value of your investment in the associate. So in order to get this now, okay, you are going to do this workings. Exactly. You are going to do this workings. So what is the first thing now? Is what is the parent company, the parent company cost of what? Investment. Yeah. In associate. What is the amount I incurred, I actually invested as staff? Then add the parent company okay, post acquisition share of reserves. If you remember, equity accounting method, is a method of accounting whereby the investment is initially what recorded as cost, and thereafter adjusted for what? For the share of the post-acquisition reserve. You can see now. So you add that, okay? Next, you less impairment. Impairment loss on investments in associate. The value of your investment in the associate might have been impaired, and you know, class, that impairment is a deduction, it's a loss. It will reduce what you have. Next, less unrealized profits on inventory. Okay, in this case, if the parent company is what? The seller. What? The parent company is seller. Plus, the treatment of URP on inventory between the parent company and associate is not the same with that of the parent company and the subsidiary. Okay, please. That was why I left you for some time so that you can go through the group account and get yourself acclimatized to the concept, because I was coming to build on it. So please take note. You don't treat the URP on inventory with associate like you have learned for the parent company and the subsidiary. No, they are different. Next now, add loan, okay? You may also add loan. Add loan to associate. This is a closing value of investment in associate. Plus, this is what? When we go to your console statement of financial what? Position at the end of the year. So this is the only figure, hello, that we need in the statement of financial position. So we don't have interest in the asset liability of the associate. It is not a subsidiary. So we cannot consolidate. We just have to measure our value of investment at the end of the year and put that under the non-current asset. Is that clear? That is that. Okay. Now, class, you know, earlier I talked about the equity accounting method. It is also important that you note, please, that the equity accounting method is actually the method that is preferred, recommended by IAS 28 for accounting for investment in associates. However, the equity accounting method will not be used. Take note of these 2 points, please. The equity accounting method will not be used if, number one, the investment in associate is classified as held for sales. As held for sales in accordance with IFRS 5, non-current assets held for sales and discontinued operation. if that investment is classified as held for sales, hello, equity accounting method is not going to be applicable. Two, if the parent company is exempted from preparing consolidated financial statements, yes, if the parent company is exempted from preparing consolidated financial statements because itself is either a wholly owned subsidiary or partially owned subsidiary of another parent company. Class, based on any of this, you are not going to use the equity accounting method. Now, what are the necessary adjustments that you and I need to talk about? The necessary adjustment, okay? The necessary adjustment that we need to talk about as regards investment in associate. Class, bear in mind that when we say consolidated financial statement alone, we are talking of three things. One, consolidated statement of profit or loss and other comprehensive income, right? Two, consolidated statement of financial position. Three, consolidated cash flow statement. So we are still on the statement of financial position now. After this, we are coming to the P or L, okay, for the parent company, subsidiary, and associate. So let's look at the basic adjustment that we might come across. Honestly, it's been a long time that I can say this. What you are going to ask to do in the exam is going to be a full consolidation. That is, it will involve the parent company, the subsidiary, and investment in associate, or the parent company and the subsidiary only. So it depends on how the question appears, okay? On how the question appears. So whichever you are good to go. Okay. The first adjustment now is the treatment of unrealized profit. Unrealized profit on inventory. The URP on class. Basically, we know that what our URP on inventory, whether P or L or SOFP, is the margin. Is the margin times what? The value of unsold goods, or inventory. The value of the unsold inventory or goods. So this is what the standard way. So it means what you are going to get your margin. Perhaps the margin is not there and you have markup cost. You are what? You are going to convert markup to margin. You know all this. Okay. Now, in the case of the parent now and the associate, okay, when the parent company sells goods to the associate or the associate sells to the parent, okay, and at the end of the year, part of the goods are still in inventory. This will result us, okay, adjusting for the URP on inventory. Is that clear? On inventory. Now, you will remember that between the parent company and the subsidiary, when you have determined the URP, what you do is that you take the URP from the consolidated inventory, okay, in the balance sheet, and from the retained earnings of the seller in full, right? The seller could be the parent or the subsidiary. But in this case now of the parent company and associate, hello, you are not going to take the full value of the URP on inventory. Be with me now. You are not going to take the full value of the URP of the inventory. The one you are going to take is going to be the portion of the parent company. How that? The portion of the parent company. I will show you now. Okay? The portion of the parent company. That will be the parent company what percentage are we holding? Percentage, the parent company percentage times the total value of the URP on inventory. How there? Now, if the parent company is having 30%, okay, that is a parent company with percentage of acquisition in the associate. You know, I said it's between 20 to 50. So whatever is your percentage times the total value of the URP on inventory. That is the portion of the parent company. Hello, this is not the same with the subsidiary. Please, this is not the same with subsidiary. So once you have taken that now, how do we then account for it? Okay, consolidation, adjustment. Now, the way to account for it now depends on the seller. Hello, on the seller. Depends on the what? On the seller. Okay. This could be the parent company or the associate. Please. Sorry, I'm coming. Sorry, please. Hello, I'm in class. Oh, I'm in class. Hello. Hello. Yes, I'm in class now. Okay, move on. Class, please, I beg of you, just give me 2 minutes. Thank you. Sorry. Okay, class now. So now, when we have determined, okay, the portion of the parent company, class, what next? How to account for it, okay, will be determined by who sold the goods. Is it the parent company or the associate? Please, let's see now. A, when parent company is the seller, when was the parent seller? Class, in this case now, the inventory would be in the account of the associate. Is that clear? So when the parent company is the seller, it means what the closing inventory is in the account of the associate and not the parent company. So this is what you are going to do. You will debit, you will credit. Okay, debit the consolidated retained earnings. Okay, now what? Credit investment in associate. Class, please, I'm coming. That is, you are what? You are going to subtract, okay? Subtract the parent company portion of the URP from both what accounts, from both accounts. So you will be told by the question, okay? Please, yes, please go on, go on, go on, go on. Hello, please go on. Yes, sir. Yes, sir. Go on.
Somebody is asking to help him, let him into the class.
Hey, but I'm here. Hey, yes. No, that is why I come to the back here to see. They are not here. Maybe it's a network.
Has been sending messages.
That is why I always come back. Hey, now wow. Hey. Thank you. Okay, class. Please, that is clear, right? Now, if the associate now is the what seller, okay? When associate is the seller, okay. In this case now, it is the associate that sells the goods, okay, to the parent company. You are going to agree that the goods will be in the inventory of the parent, right? Okay. So now we are what? We are going to debit and credit the consolidated inventory. Sorry. Retained earnings and consolidated inventories. So class, if the associate, because the question will tell you, okay, who the seller is. So you are not just working on assumption. You'll be told who the seller is. So it means you will subtract what? You will subtract the parent company's portion of the URP on inventory from both accounts. Class, please on that. Are we clear? Hello? Hello, class? On that one, are we clear? So that is that.
Yes, sir.
The next one now.
Thank you.
Is, okay. Yeah. The next now is the treatment of impairment. Yeah, impairment. Impairment. When your investment in associates, okay, has suffered an impairment out there, do we have that in the question too? If there is, impairment, loss on investment in associates. Number two, impairment, loss. Actually, when you say impairment, is a loss, okay? So when you say loss again, it's like what? This thing. So it's just a loss anyway, because most of us are used to that slang, saying impairment loss on investment in associates. Class, when the question tells you that, oh, your investment in associate has suffered loss, what happened? Meanwhile, the value of your investment in the associate is what is reduced, okay? Is reduced. So the consolidation now, okay, treatment you debit, you credit. The consolidated retained earnings and you what? You also will credit the investment in associates. You know what? You are going to subtract the impairment loss on investment in associates from both accounts. Yeah. Retained earnings is an income account. And by standard, income account is meant to be credited. But when it is not debited, you are taking away from it. Why investment in associate is an asset account. That is also to be what? Debited. But by the time it's now credited, you are also what? Taking away from it. That is that. The next one now, the post-acquisition. The post-acquisition reserve. Okay? Post-acquisition reserves. Post-acquisition of let me see, okay, of reserve, okay. Reserves, yeah. Class, this is an investment in associate. So we cannot consolidate like we always do for the parent and the subsidiary. So what we are going to do is that we are going to take whatever is our share, okay? Whatever is our share from the associate, and that is that. So one is what? The post-acquisition of reserves. Now, let's say here is the retained earnings. Retained earnings. Okay. There will be an opening retained earnings class and what? And the closing. Okay. When you make that investment in the associate, on that very day, there must be a retained earnings of the associate. That is the opening retained earnings. And at the end of the year too, there must be a closing retained earnings. So you will say the parent company's portion, okay, will be the parent company okay, percentage, right? Percentage holding times closing retained earnings minus opening retained earnings minus opening retained earnings. So class, the closing retained earnings of the associate, okay, less the what? Opening what earnings. That will give us the post-acquisition reserves, okay? The post. So now, the portion of the parent now will now be the parent company percentage times what you have here, okay? Times what you have there. So how do we account for that as well? Consolidation, adjustment, or treatment of this debit, credit, because it is again to us now. Therefore, it will increase our investment in associate. You add to investment in also increase now the consolidated retained earnings. Add to both accounts the parent company's share of post acquisition reserves. Okay, class, we are almost there. So the last one now, class, also, okay, apart from the retained earnings alone, you could also have things like other components of equity, okay, right? Do it in the same way, okay, in the same way, okay. So that is that. The last thing here I will show us is the loan, treatment of loan. Loan from parent company to associate company. Class, it is possible, okay, that a parent company might advance loan to the associate. Now, how are you going to treat this loan? Bear in mind that the associate is not a group member, it's not a subsidiary. Therefore, the loan from the parent company to the associate is not an intra-group balance. Is that clear? So Adi Bin is from the parent company to subsidiary. Aha, that would have been an intra-group balance because the parent company and subsidiary are members of the group of the same people. So, but between the parent now and the associate company, the loan is not an intra balance. It is just a normal transaction. So, according to IAS 28 class, okay, the loan from the parent company to the associate can be treated in two ways. Number one, hello, you can add it to the cost of your investment in associate. If you look at the equity method I showed you earlier, I prefer to add it. So it is the last thing there, okay? Loan to the associate. You can add it, okay, to your investment in associate. That is the first treatment. Secondly, you may decide to show it separately, okay, separately under the non-current asset as what? As loan, okay, as loan investment, okay, as loan investment. So class, with this, are we clear? Are we all clear now, yeah, with this? So let's go now and take a question, okay? Let's take a question. Please, are we together, please, class? Hello?
Yes,
Hello,
sir.
class?
Hello, sir. Together. It's just that I don't know if it's from your side or from my own side. The network, the board is not that clear.
Class, is that true? Because it's very clear here.
It's very clear
It's
here.
very
We
clear.
can't
It's
hear
your
anything.
network.
Very
It's
clear on my
from
side.
it's from his
Because I
end.
can log in.
Okay,
Mm.
thank you. Okay, no, sir, try to tap, okay, on that whiteboard on your listing. Double tap on it. I think it will be better. Okay, let's go now and take one exam question to do this. Okay. You know the material I sent to you. Okay, Mr. Edwin, go on, go on, go on. Joel is up.
Okay, sir. I don't know that was the one that joined the lectures late. We started the IFRS 15 revenue for contract with customer last Saturday.
No, 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 no. Hello, hello. See, Saturday is IFRS. Okay, Tuesday is the other aspect of your FR out there. Hmm? Your FR syllabus, okay, consists of the group account, published account, the framework, the standard, and others. So what we do on Tuesday, hmm, is the other aspect of your syllabus on FR. Saturday only is for the IFRS. Are you clear now?
Yes, sir. Yes, sir.
Okay. Okay.
Please,
So
are we still going to have a fire in the night?
no, 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 no. That is
Okay.
why we are doing it now. Because I
Okay.
want all of you to maximize today to watch this video from A to Z. Yeah. Because next class we are going to the P or L. Okay. To the P or L.
Okay.
Sorry. Look at question number three. 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 Class, are we all there? Please. If you have followed me from the scratch of my group account, so I don't expect you to have any issue, honestly. Because all the adjustments we have done so far, okay, between the parent company and the subsidiary is still 100% applicable. Because your question in FR on group account might be between the parent company and the subsidiary, number one, or between the parent company, the subsidiary, and associate. And so far, we have treated the one between the parent company and the subsidiary. Okay. So today, we are going to look at between the parent company, the subsidiary, and associate. So that is a requirement of our syllabus. Okay, class, let's go there. Question number 3.
So sorry, which material are we using for this?
The material I posted, I have posted the material since yesterday, right? Yes, yesterday. Question 3. So here we are asked to prepare the consolidated statement of financial position. Now, class, seeing that question, okay, you can see 3 companies there, right? 3. You should know that this is a case of associate. The first is the parent, second is subsidiary, the third is associate. So let's consolidated.
Hello, sir. How do we know, sir?
When you have 3, okay, you have 3. Then the third is the associate, okay? So the third is the associate. What you were used to before was 2, the parent and the subsidiary. Also, the question will also tell you, okay? It will tell you. Go on, sir, please. Go on.
Yeah, just in line with what my brother asked. I don't know the name because I remember when we are doing for subsidiary companies, we also have sub-subsidiary company.
Hello, you are not doing sub here, okay? I said for your FR, what you are doing is just a single subsidiary and 1 associate. Sub will come for those in final doing SVR. Okay? Okay. So if I can give us that one, this level. As at 31st December, okay, class. Now remember the rule that we have always adopted. Please listen to me here carefully, please, because this is the only example I am giving us. And this question is very, very wide. Yes, it's very, very wide. So, when you open this, you are going to add together the asset and liabilities of the parent company and the subsidiary. Is that clear? So, you have here non-current assets. You have freehold property, for the parent. You have 48750 plus 31250. The plant and what equipment. I told you, you are not going to touch anything from the associate plus 9375. Also, the investment, like I've always told us, okay, you are not going to touch the investment. So, go on. Let's go on. Go on.
How are we going to know which one is associate among the three companies?
Okay, if you read the question, right? The question, okay. The first one is the parent company. Okay. The second is what? The subsidiary. The third is always the associate. Are you clear? Are you clear? But I am still going to show you now. Shortly. The first is the parent company. Okay. The second is the subsidiary. The third is associate. Okay. You know that the investment is not always coming here, right? So leave a line. So for goodwill. Now you will now give this to say investment in associates. Are we there, class? You can say. So that is the only thing, the only line that will represent all our investment in associates. A single line. A single line. So we are going to calculate this. So that is that. Next, we move to the current asset. Here we have inventory. We have 14,375 plus 75. Trade receivable. We have bank. And cash. 1250 plus. Okay, please, Solomon, please bring your hands down. Thank you. So that I can have the right screen. Thank you. Okay. Okay. After that class, you know what? We go to the equity, right? To the equity and liabilities. So the equity and liabilities. You know, I've always told you, it is only the equity of the parent company you are going to show. Okay. Here we have the ordinary shares. okay, of the parent company, that is 50,000. Let's put this here. Then you have retained earnings. Class, remember that the consolidated retained earnings of the parent will always be shown as workings, because one or two items might still come in. Next, okay, non-current. So here you have the NCI. The value for the NCI2 will come as workings. All those things you always do for your normal parent company and subsidiary, you do them. Here you have the non-current. $12 loan note. There you have 17.5, right, class? Please check for me. 17.5, okay? And what?
No, it is 12.5.
It is 12,500.
Okay, sir.
It's 12.
Oh, okay, sir. Thank you. Thank you, sir. 12.5 plus 2.5. Next, now the current liabilities. Everything I have taught you under parent and subsidiary, you are going to do them. Okay, because you have the parent and subsidiary. Trade payables. The parent, 17,000. Subsidiary, 875. You have no business at all with the associate because of bank overdraft. The parent is 14,000. Class, my people, once you have done this, then you will now come here, okay, and open down the workings. As my good student that has followed me carefully, who has watched the videos, not those just who are just taking those down. Now, after this now, what am I going to do? Yes.
Determine the group structure.
Thank you.
Not so.
Thank you. Thank you. Determine the group structure. Determine the group structure. Class, the only thing here, hello, that is what different is that Mr. Associate. That is all. That is all. And you have no fucking business with the associate asset and what, because you don't have control over it. It is not a subsidiary. So you don't have to add it. But you are going to click just one line here that will help us value, that will help us show our worth of investment in the associate. So let's go now. The workings. The workings now. This is my line. Okay, working is one. Group structure. Okay. Class. Who is the parent in this case? Let's see. Note one. Orobo PLC. Let's see. Orobo PLC acquired 15 million ordinary shares in Lepa Limited in January 2013 for 25 million. That is what the cost of investment. Please take note of that. When the retained earnings of Lepa Limited were 5 million, that is the pre-acquisition retained earnings. So, okay. 2, at the date of acquisition, of Lepa Limited, the fair value of its free property was considered to be 10 million greater than its value in Lepa Limited statement of financial position. Okay? Lepa Limited had acquired the property in January 2013. Okay? And the building element comprising of 50% of total value is depreciated over 40 years. Noted. Orobo PLC acquired 5.62 million 5 ordinary shares in Opeke Limited on January 1st, 2017 for 12.5 million. When the retained earnings of Opeke were 3.75 million. So, class, in this case now, it is clear that Orobo is the parent, Lepa is the subsidiary, Opeke is the associate. But the percentage of the parent company is not clear. So, let's see now. Orobo. Lepa and Opeke. Okay. Lepa Limited and Opeke Limited. So we don't know the percentage, and there is not how you can consolidate, okay, without the percentage. So let's come here right away and do that. Now, let's say Lepa now for Lepa. What is the total number of shares that we bought there? 15 million, right? 15 million ordinary shares units over what is the total number of shares in Lepa? This thing I have taught you before that in most cases you might not have the percentage, okay, but they will give you the number of shares that the parent company acquired. Plus, how am I going to find now the total number of shares of Lepa, the subsidiary? Hello.
18,750 divided by 1 naira.
Number of shares number of shares the subsidiary has in the parent company has in the subsidiary all over the number of shares of the subsidiary. Times 100.
Now, thank you. I am saying what is the total number of shares now of the subsidiary? Tell me.
It's 25 million because
Thank
it's
you.
25
Thank
million
you.
value divided by 1 naira.
Thank you. Thank you. Go to the balance sheet. Okay. What you have there is in value. You are going to convert value to unit. Divide 25 million naira by 1 naira each. There you are having 25 million. We have discussed this at length. Times 100. Plus, that's what now?
60.
Is what?
60%. 60%.
60%.
Thank you. 60. So here you have 60%. Okay. So we are having NCI for 40%. Is that clear? Also now, Orobo also bought in Opeke. Opeke. What is the total shares bought there? There we have
5.625.
I don't know. Please, do we know how to get that clear? That way. The 5. Right? What is the total number of shares in Opeke? The same thing. Go to the balance sheet of Opeke, convert the value to unit. There is having 18 million arrays 30. So you divide that 18,750 by 1. There you have 18,750. That gives what?
30%.
Now, you know, this is an associate. You can see this question covers all the adjustments you might ever come across. Because, please, madam, your video is on. If I pause this video, it will show you. I don't know. Shidera. Okay, please. So, class, after this now, what is the next step? The net asset of the subsidiary. You know all that. You have your DOA, DOC, post-acquisition reserves. So go to the subsidiary now. Here you have the ordinary shares. There's 25 million. You have pre-acquisition retained earnings. I told you that when you are looking for your net asset, okay, you use pre-acquisition retained earnings. And go to note 1. When Orobo acquired Lepa, here you have 5 million retained earnings. That is a pre-acquisition retained earnings. Hope we are clear. That is a pre-acquisition retained earnings, 5 million. Okay. You leave some lines, okay? Next is the good way. You cannot find a good way until we have determined the net asset on the OA. Of goodwill. What is goodwill? The parent company cost of investment. How much did the parent company invest in LEPA? Go to that note one, is clear. How much? 25 million. 25 million. Add NCI value. So the value of the NCI here, we don't know yet, but we can also run through the question. Let's check to see. Go to note 6. NCI is valued, okay, at full fair value. At full fair value. LEPA limited shares, there was, we are trading at 1 naira 60 kobo plus. So in this case now, okay, the NCI is at fair value. Let's come here. NCI workings. Now, whenever they give you the share price of the subsidiary, out there, the share price of the subsidiary, and you are told that the NCI is at fair value, of course, what you are going to do is that you are going to determine the NCI percentage of the subsidiary total number of shares. That will be, since Honorable bought 60, we have 40%, I mean, for the NCI, and the subsidiary has 25 million shares. So once you get that now, times the share price, the fair value of the subsidiary shares, that's how much? 1 naira, okay, 60 kobo. Is that clear? 1 naira. So, class, what would that give us, please?
$16,000.
16,000. Okay. Thank you. This is the value of the NCI, okay, on DOA. Sometimes they might give you directly. So that comes here. NCI 16. Okay. So you also leave, okay, gap, as you know. Go and show your consolidated retained earnings. You know all these things now, yes?
Excuse me, sir. Is NCI not supposed to be number 4?
No. In this case, okay, I said the NCI should always come last, okay? I have told you. Do it last. Okay? Do it last. there is no even a particular way of doing it, but it is just good that we have a pattern that will help us. Now, class, what do you understand by this? This is what the parent company retain. So, what is the balance? Please tell me. Balance as per SOFP. Yes.
36.5.
Let me check. If you are right, I will give you one cocoa. Thank you. Yeah. Okay. I'm owing you one cocoa.
Abi.
36.5. Okay, that is good. After this now, show the what? The adjusted subsidiary retained earnings. You know all these things now. So let's come here. You know, here, the parent company here is having just one reserve retained earnings. Remember, are they being there is other component of equity, you will also show it, or other component of or revaluation of surplus, you will also show it. But here it's having just one reserve retained earnings. So let's come here to note 5. Adjusted subsidiary retained earnings. I want to manage this board. Adjusted subsidiary earnings. Now, class, what is the balance of the subsidiary retained earnings as per account? Tell me.
22,125.
Correct.
22
That is good.
million.
Balance as per SOFP 22125. My people, after this now is your NCI. Have you now? 6. NCI valuation. So the NCI value at DOA, here we got 60 million. Class, this is the normal thing that we always do for consolidated statement of financial position between the parent company and the subsidiary. But now, we now have additional person called the associate. The associate. So you are going to create now an extra column or extra what adjustment. We call it 7 here. Investment. Now, in what? In associate. You can see now. Investment in associates. Yes, that is the extra one you are going to create. That is why I keep laying emphasis. Please, my people, master the ones we have done so far. Because every other thing will just be an additional or an extension of what we have done. So, what is the cost of investment now? Yes, yes. Cost of investment is how much? Hello, tell me now. Go to the note.
5,625,000.
12.5.
Okay. 12 point what? 5.
5.
Thank you. 12.5 million. You open all this down. That's all. This is what I taught you. You open it down. After you have done this, then come back again to the note one after the other. It's as simple as that. So, class, remember your group structure, the net what? Asset of the what? Subsidiary, the goodwill, the parent company within the adjusted subsidiary, the NCI. I would have stopped there, but we are having associate. You create an extra column for that. So let's look at now. Note one. Note one. Note one, yeah. Audible PLC acquired 15 million ordinary shares in Lepa Limited in January 2013 for 25 million. Okay, when the retained earnings of Lepa were 5 million, we have used this information. This is called cross-checking. I will cross-checking. After you have done this, you start from the what? From the start again. Pick the note one after the other. That is how to do good account. B, at the date of acquisition of Lepa Limited, the fair value of its freehold property was considered to be 10 million greater than its value in Lepa Limited statement of financial position. Class, what do we call this, please? Yes.
Fair value
Yes, yes.
gain.
What is what? Is what?
Revaluation. Asset
Fair value
revaluation.
gain.
Valuation surplus.
Or the valuation
Thank you.
surplus.
Fair value. Thank you. I'm glad you get it. Yeah, that is good. So now, what are you going to do? You are what? Going to add to the net set, Abi, and the balance sheet. Come here. Fair value gain, okay, on property. Say, Abi, it's not 10 million. Yeah,
Yes, 10 million.
10 million. Because an increase in our asset will increase the net asset. So also to the what? To the console statement. 10 million. This is 50. Over there. You can see. So there is a clause in this question. Class, let's see. There is a clause there. Let's check. Now, so this property, hello, okay, class. This property consists of building and land. And land. And they are saying 50% of the value is for building and for land. What are they saying? That is, our extra depreciation now on that fair value surplus, okay, shall be what? Shall be based on the portion of the land, of the what? Of the building alone. There you are. 8. Extra depreciation or fair value depreciation, whatever. Now, the total fair value gain is 10 million, and we need for only building. So building is what is 50%. Abi? So that'll be 50% of the 10. That'll be 5 million. So half of the total fair value gain is for the building. You know, land is not depreciable. Okay. Therefore, depreciation now, the fair value gain, on the building only over the remaining useful life times what? Times period. So here we have 5 million. What is the number of years on that building? Tell me, class. Yes.
40.
40
years.
years. Okay. Thank you. Okay. Now, how many years have we used on
4
this
years.
asset? Is what?
4 years.
4 years.
5
Are you
years.
sure?
5 years.
Are you sure?
2009 to
Let's see, class.
5, 6,
Now,
7, 8, 9,
from
10,
the date of
8 years.
acquisition, okay, that is what?
8
On the 1st of January, okay, 2013. Hello, please your mic, okay, 2013 to 2020 to 2018. That is
6.
how many years? 6 what?
6 years.
6 years.
Okay. Thank you. 6 years. Please. So, what do we now have there?
$7.5.
Fantastic. Please. Class, this asset is owned by the subsidiary, okay? So, and the subsidiary has not captioned this depreciation before it determines that it's so-called retained earnings. So we are coming now. Let's do what? less that depreciation here extra depreciation. $7.5. Also, from the console PPE, so that we reduce the value of the asset now. The same thing. Yes. You take away the depreciation too. That is that. We have done that.
It's 750 or no 7.5, sir.
Oh, hey. Oh, thank you so much. Thank you so much. 750 from both, not 7.5. Thank you. 750. And then, funny enough, if we had used that, the account will still be correct. But there is an error. Yeah. $750,000. Okay, class. That is that. So the next note now, note 3. Our PSC acquired 5.62 million ordinary shares in Okpeke, okay, Limited on January 1st, 2017 for 12.5 million. When the retained earnings of Okpeke was 3.75 million. Class, we have used that, but we also need one thing there. The parent company share of post-acquisition reserves of the associate. Are we there? The parent company share of the reserves. I will make here note 9. Note 9. Of post-acquisition reserve of associates. Now, I told you is the closing reserve of the associates less the opening. So the closing is what we have in the balance sheet. I mean, 9,750,000. So there you say that way the parent company percentage is it clear? Okay, percentage times the closing retained earnings. Let me use black for you. Black. Say percentage times the closing retained earnings minus opening retained earnings. So class, what is the closing there? Here we have 9 million, Abi. That's it. Here we have 30%, okay, for the parent company, 30%. You have there 9 million. Yes, 9,750,000. 9,750,000. Less the opening. That is what? 3 million, Abi. So class, what would be the parent company share of the associate reserves? Tell me.
1.8.
Yes, yes. 1.8. Thank you. This you will add to the consolidated retained earnings and investment in associates. Come here. Add parent company share of associate reserves 1.8. The first leg, okay? You will also add to the consolidated retained earnings. You will also add here. Associate reserves. Associate. Okay. Reserves 1.8. So we have done that. So the next thing now, so note 4. Note 4. Lepa Limited manufactures components used by Orobo. Used by Orobo. Okay? Used by Orobo and Opeke. Transfers were made by Lepa Limited at a cost plus 25%. Orobo held 2.5 million of inventory of these components at December 31st, 2018. In the same period, Orobo sold goods to Opeke Limited, of which Opeke Limited had 2 million in its inventory at 31st December 2018. Honorable PLC mark this good up by 25%. Class, what do you have here? Yes. Yes, class.
Yes, class.
Thank you.
Profits.
Thank you. Working stand. Working stand. Realized profit on inventory. You know, we are having things here now. One, subsidiary sold to the parent. Two, the parent sold to the associate. So please say the case one from the subsidiary from Lepa Limited to Audible. So the URP now on inventory here. What is the value of the goods unsold here, class? Let's say the value of the goods unsold.
2.5.
Thank you. 2.5. Now, you know, it is at markup. So convert that markup to margin. That what? 1 over what? 5, right?
Yes.
1 over 5. Okay. So what would that give us?
$500,000.
Thank you. 500,000. Class, this is a case between the group members, the subsidiary, and the parent. So what are you going to do? Take it from the retained earnings of the seller, number one. Two, from the inventory. So in this case, you are not going to take based on percentage, please. So yeah, the inventory. Oh yeah, say 500,000. The seller of this good is the subsidiary. Okay. Let's URP. Sorry, I'm coming. Okay. 500,000. Okay. Please go on. Cynthia, go on.
Okay,
Yeah.
markup you converted. I'm seeing 1 over 5. It's not supposed to be 1 over 4.
Yes. No. 25, okay, over 100 plus 5.
Oh, okay.
Okay. Now, that is that. The next case now, between the parent, Orobo, and the associate. And Okpekiabi, yeah. So what is the value of the goods sold? 2 million. The URP is 2 million. The same policy, Abi, 1 over 5. That will give us what?
$400,000.
Stop. Is what? Hello?
400,000. 400,000.
Okay, thank you, ma. 400,000. Now, remember, this is URP between the parent and associate. So whatever is going to affect the parent will just be based on the percentage. Therefore, the parent company here now or portion will be, here I'm having 30% in associate.
Sir, can you move the board up, sir? You cannot sit it down.
I'm still solving. Okay. 400,000. So what would that be now, class?
120,000.
Thank you. Please, you cannot see the difference now. Okay. In the how to treat the URP on inventory between the parent and the associate. Please, that is very, very important. Now, I told you earlier that once you have gotten this, the most important thing you should ask yourself, who sold the goods? Yes, who?
The parent.
So if the goods are sold by the parent, now, how are you going to pass the adjustment?
Remove 120,000 from within any consolidated within any.
Yes. Now,
investment in associate.
Thank you. It will affect the investment in associate and the parent company retained earnings. Thank you. Okay, let's do that now. Because it was sold, it is important we understand the seller of the goods. The first thing there, also the consolidated earnings, which is owned by itself. We come here, less. Less URP inventory to associate. So now you can see the difference in the treatment of the URP. Okay, Cynthia, go on. Your hand is up. Cynthia, go on.
Sorry, that was before. I've asked already. I'll take me down.
Okay. Okay, so now note 5. The goodwill of Lepa Limited is impaired and should be fully written off. An impairment loss of 2.3 million is to be recognized on the investment in Okweke class. In this case, we are having two impairments. I mean, one on the investment in our associate. Is that correct? 2 on the goodwill of the subsidiary. So let us quickly now find the goodwill now. Since there is no other information, here we can say our net asset now on DOA will be 130, right? Sorry, 130. Please class check on me. 130. Is that correct? No, 13,000.
No, it's 40.
13. No, 40. Okay, 10.
Yes,
That's
sir.
40.
Is what?
40.
So you can now find the goodwill now. Please help me add this up. Total purchase consideration. Yes, class. This is what?
41,000.
Thank you, 41,000. Now, less the net assets now. On DOA that we got here, 40. We are having 1 million as goodwill on acquisition. There is a keyword there that the goodwill is fully written up. There is an impairment. Okay. So now, impairment now. Of 1 million. Fully written off. So there is no more goodwill. The carrying value of the goodwill is new. Now, what method is it used to measure the NCI? Class, tell me.
Fair
Let's
value.
start from there. Thank you. God bless you. Now, if it is not fair value, how are you going to treat the impairment loss in the subsidiary?
Both subsidiary, NCI, and parent company will bear the
Thank
loss.
you. NCI and parent company. Wow, I'm impressed. NCI and parent. So we now come here now, right away, give this man his own share of the loss. Parent company. See? Share of impairment. Now you are having 60% as parent, and we have impairment of 1 million. So how much is that? Around 600. Let the NCI to take his own share too. They shop together, they must work together. NCI too. Share of impairment. 40% of 1,400,000. Yeah, you have done that. There is another one there. Impairment in investment in associate. Okay, class. How are we going to treat that? Tell me. That is 2.3 million. Yes. How? Yes, class. Let's talk now. Please, let's talk.
The impairment from consolidated retained earnings and investments in associates,
Thank you.
which is
That's all.
2.3.
Okay. Let's say impairment here. $2.3. Yeah, on that, okay? So this was the last year. So the parent companies too, because whatever happens in the associate would affect the retained earnings of the parent. He is the owner of the investment. In associate. Class, we are done now. See, we are done. So the last note there, okay, just tell us how to follow the NCI. So let's go now and close the account. We are done. Firstly, let's find the adjusted subsidiary here. Yes. Please, what would that be for us? Two 22,125 minus 750 minus 500. 20 Abi 875.
475.
No, it will be 2875. Please, class, let me check it too.
2875.
2875. Okay. The adjusted retained that will come here. 2875. This will still be 25 million. So the closing minus the opening, you have new. This minus this, minus 5,000, have 15,875. So here we have 15,875 as our post-acquisition reserves. You can see as our post-acquisition reserve. So that is what we are going to share. So that will be shared between the parent company and the NCI. So let the NCI take its own share here. See, add NCI share. Okay, that way 40% of 15,875. 0.4. That will be 6 Abi 6350. 6 3. So let's find now, okay, the closing value of the NCI. So 16,000 minus 400 plus 6350. That'll be 21. Okay, 21,950 out there. 21,950. This is a closing value of the NCI that will go to the consolidated statement of financial position. So let's also find the closing value of our investment in associate. 12,500 plus 1,800. Please, class, let me check you. Okay. Minus 120 minus 23. Yeah, I have 11,880. Okay. 11,880. That is the closing value of our investment in associate. 11,880. So last now, let the boss itself, the parent, take its own share of profit. Add parent company's share of post-acquisition reserves of the subsidiary. You are having 60% as the boss, then of 15,875. Okay, 0.6 times 15,875, 9,525. Please let me check. 9,525. We add now. Okay, class. 36,500 plus 1,800. Okay, minus 120 minus 600 minus 23 plus 1,925. Here I have 37,200. That is the adjusted retained earnings.
Oh, that's 60%. 9,525, no 1,925.
Hey. Okay. No, check you. 60% of 15,875. 0.6 times 15,875. Okay, thank you. 9,525. 9,522. Hey, thank you. 9,522. Oh God. Okay. Please help me get the figure. 36,500 plus 1,800 minus 120 minus 600 minus 23 plus 9,525. Okay. 44,80. Hope I'm correct now. Cynthia? 44,80. Okay. So class, we are done. Okay, so let's go now and close the account. Remember, you are going to reach this one to the account, the NCI and the investment in associate. Okay, let's come now here. So if you close this now, what do we have here? Here we have the investment in associate. That'll be working 7. 11,880. What is our plant and equipment? Please help me out, please. My people are just writing no. Okay. Here, 48750 plus 31250 plus 10,000 minus 750. Here I have 89250. Okay, here 19875
29250
plus 9375 29250 29250. Thank you. So the current now, the inventory
Goodwill.
14.
Goodwill.
No,
No,
is zero.
goodwill.
Okay. Yeah.
Okay.
The goodwill is fully written off. It is totally written off. 14375 14375 plus 75 minus 500. 21,375. Please let me confirm. 8250 plus 7250. 15,500, okay?
Then 4250.
Okay. Please help me stop now. Your total asset now, okay? Now, for year now, equity, okay? Because the parent company did not issue any share as purchase consideration, so it means the value of its shares is the same. Just say plus 0, okay? Here we are, 50,000. The retained earnings that we got here, note 4, the console retained earnings is 44,805. So help us add that first. 50 plus 44,805. 94, right? Please, class, let me check you. Now, the NCI now, that is note 6.
So I bring the camera down.
Okay, it's off. Oh, that's true. Sorry. Oh. The NCI note 6 is 21,950. You also add up, okay? Plus 21,950. There you are. 116 755. This is called group equity. Okay, the total equity of the group. This one is called the parent's equity. So there you have 0. Nothing comes here. Okay, class.
Sir, please take your board or your camera off.
Okay, my people are busy writing. Okay. Now, the 12% loan now, okay? 12,500 plus
15,000.
25. Thank you.
It's 25,750.
25,750. Thank you. Okay. Total equity and so class, let me add now, please. This
One
is
second.
The first one is 171,545.
171501.
171,505. Okay.
Same
Same
with
thing
the
as
first
top
one.
one.
Same with the first
Balance.
one.
1755. Class, this is a standard question on the group balance sheet involving associate. You must not go to bed tonight without you watching this video. Please, you must do. That is why we had the class earlier. In the next 2 hours now, you will have the video. Okay. So go on. Yes, Nessa. Yeah, go on. Nessa, go on. I'm with you, Nessa. Okay. I guess our network throughout. Oh, pity. Class, please. Any question? Somebody shouted that why aren't they having group account or the why? I said it was on purpose. Yes, that I wanted you guys to have time to digest the one we have done so far. We have solved standard exam questions so far before I come to build on it for you. And that is what we have just done now. Please, by God's grace, I don't expect anyone here to have issue with the preparation of consolidated statement of financial position between the parent and subsidiary, again, between the parent, subsidiary, and associate. If I'm going to show you anything else, that would be the treatment of other purchase consideration. Okay, there. The treatment of other purchase consideration. Out there. So, class, our next class, by God's grace, shall be the preparation of consolidated statement of profit or loss and other comprehensive income between the parent and subsidiary. After that, too, we are going to look at between the parent, subsidiary, and associate. Then we can say bye-bye to group. Then we go to published financial statement. So, class, any question, please? Any question? Okay, thank you very much. Please let us use this time to balance our house. Okay, go on, ma. Yes, go on,
The
ma.
last time we were discussing the types of purchase consideration. You said we have a situation where we pay part payment. So I don't know how we are going to keep that one.
You see, ma, I just said it now. Okay. Now I am trying to get a question that will cover that. We have cash, we have deferred payment, we have share exchange, and we have contingent. Okay, but at this level, we don't expect I can to ask you contingent. Yeah, but at least you should know the share exchange consideration. I will look for a question. Yes, I'm trying to compile one, but that shouldn't be an issue at all. That is just a minor. That is just a minor adjustment to what we have done before. Okay, ma'am.
All right.
No issue, ma'am. Okay, ma'am. So thank you very much. So expect the video in an hour's time or plus.